We are looking at a market that on the whole is still higher because of China's surprise interest rate cut. Given that we've gotten Ben Bernanke's prepared remarks in which he does not say anything about easing and does not detail any kind of steps that he might take if he needed to go down that path, does China's rate cut change investors' level of expectation for coordinated policy action here?
Oh, I don't know if we're going to get coordinated policy action, maybe in terms of the Eurozone crisis. But I think China's rate cut and the fact that inflation has come down, really freeing up a lot of other global central banks to do the same, is arguably more important than what the Fed might say or do at this point. I agree with one of your prior guests. I think the efficacy of additional ease from the Fed is questionable. Our problem in our economy is simply not rates being too high. I think it's a confidence issue. So I actually hope that he takes the opportunity to really turn up the heat in terms of the fiscal cliff, which I think is weighing on confidence more. And the inflation situation, which has really eased significantly, given that for most other global central banks, that's their sole mandate. I think what we see coming out of China, given their impact, the impact on their economy of what's happening in Europe being even greater than in the U.S., I think is extremely important. So additional ease in terms of the global growth problem, I think is very important.
All right, we did see commodities higher after China's rate cut. Will we start to see these oil and metal prices head back to the point where people are talking about inflation as a problem again?
Oh, I think we're a long way away from talking about inflation as a problem. I think maybe a reversal, a short-term reversal in commodities would be a good thing if it was driven by assumptions that global growth is not falling off a cliff here, which I think was probably the last leg in the move down. And let's also remember, since the Fed went to a 0% interest rate policy at the end of 2008, which really disconnected the relationship between the stock market and short-term interest rates, energy prices have really taken over as that mechanism for pulling in and giving back. And we have seen the stock market and energy prices move very, very closely in terms of correlation since then. So I actually think an environment where yields start to move back up again a little bit, you get a little bit of a lift in commodity prices, would actually be sending good signs about the economy and would probably also be accompanied by a better stock market.
Okay, but going back to China's rate cut and the fact that it was a bit of a surprise, China's preferred method had been to raise banks' reserve ratio requirements. What does it signal to you? Does it mean that China's economy is doing much worse than what a lot of people had been expecting?
Look, this is somewhat anecdotal, but I was in China 2 weeks ago for a week, and I came back with an interesting impression, and that is that the folks with whom I spoke, both expats, American expats who had business over there, as well as the local Chinese, they were a little bit more pessimistic about their own economy than I think the consensus is here. Not dire, but a little bit more pessimistic. Interestingly, they were generally more optimistic about the U.S. economy than I think consensus is here. So that was a pretty interesting takeaway from my recent trip.
That is. Given that, though, so much of U.S. corporate earnings are dependent on growth overseas. If this rate cut does show that China's economy is doing worse than people expected, and your anecdotal evidence suggests that, what does that mean for U.S. corporate earnings? I mean, in the first quarter, we heard from companies like Caterpillar, 3M, UPS, all highlighting slowing China's sales. Will that be an issue again?
I think it will, but not across the board. What you have seen in the last couple of months is a huge divergence in terms of the performance of those companies that have more of their revenues and sales domestically biased versus those that have more of an international bias. And you've seen a very, very wide spread develop between the two. So to the extent economic growth globally and in places like China continues to weaken, I think that will be the bias in terms of the stock market, a move toward more domestically oriented sectors, domestically oriented companies, and I think that will continue to be the trade. That does not mean the entire market is taken down, because it's still the case that about half of S&P top-line growth comes from domestic sources. And
that would be your recommendation for those who are looking to buy U.S. stocks as well, to focus on these domestic companies? Well, for now anyway, but again, I think with the allowance now for global central banks to come into ease and the firepower that countries like China have with their reserves, with the ability for central bank continue to ease, I'd be very careful about getting too defensive, because they have a lot of ammunition to try to rejuice the economy again. And they won't be shy about using it again? Right. Yes. I think we saw that today. Okay. Do you expect more interest rate cuts from China?
Not in the very near term. I don't think the conditions are such that we're likely to get back-to-back, but to the extent that they don't see the improvement in the near term, then I think it's something that remains on the table. I'm not a China central bank expert, so I wouldn't attempt to forecast what the Fed's going to do. I'm not going to try to do it with China's central bank. But
they're
proving they're going to use it as a tool here.
Sure. Have markets preemptively rallied on the promise of stimulus? I mean, when the actual announcements do come from the Fed or the ECB, for instance, will there be any upside left?
Look, it's hard to judge how much of these rallies have come from the prospects for more ease from the Fed, and if so, whether that's a belief that it's QE3 or an extension of Operation Twist, or the fact that we got a better claims numbers, or the fact that the Spanish bond auction went a little bit better than expected, or simply the market had moved into oversold territory, sentiment reversed into extreme pessimism. I'm always hesitant to point to any one thing as a reason for a two-day rally in the stock market. So I'd like to believe that strength in the stock market and maybe better economic news is not solely because of the drug that is, Fed policy.